Good morning. It is not Tuesday, but we are doing our live today, Monday, because it was an intense weekend. If you were watching the news at all, you saw the headlines that two banks were taken over by the FDIC. And if that's the case, it's not good news. I'm just saying. So we've got a question. What does this mean? Like, is this the beginning of the end? Does it only get worse from here? And if you're sitting on the sidelines, not in the mix of what's happening in the mortgage industry every single day, you either one are ignoring it or two, you're freaking out about it, but you might not understand it. So I just wanted to come together this morning instead of delaying our live until or having it our regular scheduled time tomorrow, because we're going to be talking more about this on Thursday. But I did want to highlight this coming off the weekend. It has absolutely given our buyers an opportunity because of the flight to safety, which I talk about a lot at the Warning Graphic Images class for DMAR, which happens to be tomorrow. So I'll be talking about that again tomorrow with DMAR's economic update. It's our 2-hour CE. If you're not currently signed up and you want to be, there's still spots available. It is on Zoom. And then Thursday, market update with Megan Aller. We'll be talking about what has happened over the last week, given the news from this past weekend. So here's your Monday highlight. So I want to do a quick update, though, to recap for those of you who did not know how much happened last week, and then have that, and then to have it come in towards the CPI report tomorrow, Tuesday, was already a lot. And then to see things happen with the banks or with two banks over the weekend and FDIC coming in. And of course, if you guys were watching, President Biden also took the stage this morning and talked about what the government is doing to support those who are depositors at the bank. So let's just do a quick recap, though. A couple of market highlights. So mortgage purchase applications were actually up 9%, even though interest rates had been going back up even towards 7.25. Not quite there, but mortgage rates were going up. Mortgage purchase applications were up anyway, which simply says that buyers who are out right now are serious. They're looking to take advantage, even though interest rates are higher, to get in before the full spring demand and where more buyers are coming in and running up purchase prices. We're already seeing multiple bids. We're already seeing homes over $1 million going for over $100,000 over asking. We're already seeing homes in the 400, 500, 600 range going for $25,000 or more over asking. If a home is priced right and staged right, low inventory will continue to be the story. In fact, nationwide weekly inventory fell another 6,200 units, housing units. Now that's across the country. On Thursday, we'll talk with Megan as far as how many our housing units are either up or down this past week here in our Denver metro. But I will tell you that nationwide our inventory is low. We're below 1 million. That kind of low inventory is going to continue to put pressure, upward pressure on home prices. And in fact, it's quite opposite than what we're used to. Last year, we were up significantly this past week. So to be down 6,200 nationwide is a kind of a big deal. We talked a lot about the fact that I don't expect this to turn around based on a lot of homeowners either not having a loan altogether, being locked in under 5%, being extremely financially stable with low interest rates and low monthly payments. And we've got low foreclosures, low short sales, and a very strong housing market. Homeowners are not really at risk. So what else happened? So the 10-year, we saw it popped above 4%. It couldn't break above 4.1. And now, of course, we've seen it return and change directions, right? So now it's going down, and it's going down fast given the news from this weekend. But this actually started on Friday, and it started on Friday because unemployment numbers went up. We went from 3.4% to 3.6%. And we also saw, even though more jobs were created, We saw job wage growth slowing down. That's a good thing. And that offsets the fear around the wage spiral that Powell has been talking about for so long. We also saw jobless claims tick up higher than they've ticked up or moved up in the last 5 months. Again, we don't love to celebrate those who lose their jobs, but we know that this is what we've been waiting on. All of that happened last week. What also happened was the Silicon Valley Bank on Thursday stopped trading. On Friday, the FDIC came in and it shut down the bank. This weekend, it did something different. It also came in to the Signature Bank. And if you guys weren't paying attention, that's a bank that's on the East Coast and it supports and funds crypto. So based on that bank being at risk, the FDIC came in and shut it down. So now we've got 2 banks shut down. And what we also saw was the Fed came in and set up a new bailout. So this program is actually called the Bank Term Funding Program. It allows for banks to sell, or allows the Fed to loan banks for up to 1 year in term at the current par value of their instruments. So I'm going to go into what that means, but in essence, what it did to the markets and why the markets like that. This came out on Sunday, not even before President Biden came out this morning. This came out on Sunday, and we already started to see the 10-year Treasury go lower in the European markets, which started on our Sunday evening. So we already started that happening, where the 10-year was already dropping Sunday night before our markets even opened. And it was because of this bailout. And I'm going to go into what that means in just a minute. But then, of course, we know that Biden came out this morning saying he was protecting all depositors. So we've got 2 banks that go under. I want to highlight SVB for just a second. So the Silicon Valley Bank is primarily a bank for tech startups. So they take higher risk loan or higher risk projects that they fund, right? These tech startups, obviously for higher return. Interestingly enough, 2 weeks ago, the CEO knew the bank was in serious trouble when he sold $3.6 million in stocks. One of the things that Biden said this morning was that those that were held responsible, there would be justice served. He did say that all of the management would be fired and they would start investigating right away. I have to believe that a CEO that sells $3.6 million in stocks 2 weeks before the failure of the bank is going to be highly investigated. So all of that is happening. So this bank has a lot of high net worth depositors who are also in the IT field. They're also loaning out money to new IT startups. So this Silicon Valley Bank is it's not your typical bank. And I would say that not your typical consumer is banking there. So we're not going to be an at risk for the majority or the common American. This is simply those who are starting up and more heavily suited towards the IT space. But those deposits, some of them very large, need to be reinvested. And of course, they're loaning out money as well. But those deposits need to be reinvested so they get a better return for clients of high net worth who are requiring a better return. So that bank is always looking for the best possible investments. Interestingly enough, they had a lot of their money also in treasuries, mortgage-backed securities, and other investments. Now, with the Fed having raised the Fed rate quickly and high, we keep hearing the term higher for longer. Then Powell threw in the word faster this last week. And then wouldn't you know, so Jamie Dimon months ago said something is going to break. Well, something broke. And it's the banks, and it's especially these higher risk banks. Now, the big banks are not going to be at risk because they are so well diversified and not specific to one high risk category like the IT space and the IT startups, nor the Signature Bank, where it's heavily focused on the crypto market. When you think of your Wells Fargo and Bank of Americas, they're so well diversified, and really the core of America, they have much less risk. But all of this to say What broke? The bank broke. So when this happened, we know that the FDIC came in and they created this bank term funding program, giving the bank a loan for up to a year. So the markets liked that alone. Just if I stop right there, they gave them a loan for up to 1 year. This really implies that the Fed believes with relative certainty that within a year they will start dropping their Fed rate. This immediately started having people expect, because we know there's a Fed rate watch tool, so they started to expect that the Fed is going to drop the Fed rate at least a point by the end of this year. Now remember, the last time the market believed that the Fed was going to drop the Fed rate at the end of this year, we started to see rates drop in January. Then all of a sudden, Powell kept coming out, no, slow down. We're going to go higher for longer and then faster, right? And so all of a sudden, the markets flipped around. Interest rates started going back up again because it was like, oh my gosh, we're not going to see that release that we thought was going to happen. Well, that happened again because of this flight to safety, and because they came out with this program saying that we're going to give this loan for up to a year. It implies that they expect that within a year, those instruments, those bonds and those mortgage-backed securities are going to fall back in line. Now, let's explain that because I touched on it a little bit earlier, but this 1 year idea is also intertwined with this idea that we're going to see a drop in the returns, the yields on bonds. So as an example, we've talked a lot in our Thursday updates and in other conversations around the fact that if you've got money sitting in a checking account or savings account, you should pull it out and consider a 1 to 2 year treasury. Those treasuries are doing very well. With the Fed rate increasing, we know the prime rate is 7.75. We know the HELOC rates are up. The credit card interest rates are up. Those short-term consumer loan debts are up. So also goes savings accounts. Right? So when we see the savings account interest rates higher, we have more opportunity to move our money possibly out of a savings account, say in a Chase Bank, to maybe then an online savings account, which might give me more interest, to maybe even a 2 year treasury, which might even give me more of a return yet. Well, if I had bought a treasury or mortgage-backed security or one of those instruments 2 years ago, my yield is much smaller. So if I'm a bank and I'm taking in a lot in deposits and I'm having to back it up against mortgage-backed securities and treasuries, which the FDIC, when they look at the overall health of a bank, they're looking at its assets to deposits or assets to loans. When they're looking at the ratios that back a bank, they're taking typically whatever that par rate is for that instrument. Now, they're not doing a mark-to-market, and a mark-to-market would downgrade the value of those bonds, because if I have a bond that I'm trying to sell with a 2% yield and everybody else is buying or selling bonds with a 4, 6, or 7, then nobody wants my 2% yield, so I have to deeply discount the price of that bond so that it offsets the lower yield, and it in essence gives me a higher yield, a higher rate of return, because I got it at a discount, right? So if I bought that bond for $100 and it gave me a 2% yield 2 years ago, and now that same $100 could buy me a bond at 4%, well, there's no reason I would go buy this bond at 2% unless I could get it at $50 instead of $100, thereby giving me, in essence, a 4% yield. So it discounts the value of all of those bonds. Therein lies the problem. Silicon Valley Bank had to sell off a massive amount of its bonds at a deep discount. It lost money. So not only did it show significant losses, it stopped trading. Then it closed its doors. Then the FDIC came in and took it over. Those are the things when you have to do that deep discounting, which is why the Fed came in saying, we're going to loan you for up to a year based on the coupon rate, not based on the mark to market. That's significant, because they also think within a year that mark to market will come back in line and re-engage the value of those bonds. All of that to say, there's turbulence in the market. Are these two banks it? Is it just the Silicon Valley Bank and Signature Bank? And this morning, today, they're already throwing out a third bank that might be at risk, which is First Republic. Now, we're talking about very specific, very focused banks that teetered over when this Fed rate was skyrocketing. Again, the larger banks are not at risk, but they are all under scrutiny in the sense that they've got to make sure that they are balancing. And in doing that, it wouldn't surprise me if some of the larger banks started to pull back and did not loan as much until we weathered through the storm and the Fed settled in on their Fed rate. Could that impact loans at some of the larger banks? I don't know yet. Maybe it could. And if it restricts them or they start to shrink their box and they get super conservative, I won't tell you that who's not affected by this is Fannie and Freddie. Going streamline and going retail is going to support you as the home buyer get the best interest rate right now, because Fannie and Freddie are measured off of the bonds. That 10-year treasury yield often is in conjunction with the 30-year fixed rate. And today we are seeing that 30-year fixed rate drop. Because as more people want to get out of the market right this moment to wait this out, there's a flight to safety where we're seeing more demand on bonds, more demand. When you have that, and we all know what happens when you see more demand on bonds out in the marketplace, it drives prices up. And when prices go up, the yields come down. And the yield is what is our 30-year fixed. So those yields are coming down right now, giving buyers an opportunity. Now, is this a forever trend? I don't know. And I really actually don't think so. I think that this is the beginning of things that we're going to see. What is the Fed going to do? Now, several people are coming out. Goldman Sachs is one of them, saying that they don't expect the Fed to raise their Fed rate at all at this March meeting. So the March meeting is coming up March 21st and 22nd. And we don't have another Fed meeting for 2 months. A lot is going to be predicated on the CPI numbers tomorrow. If inflation is continuing to go up, the Fed is probably not going to have a choice but to raise the Fed rate a quarter. They might raise it a quarter anyway. Bank of America is saying that they're going to raise it a quarter, whereas Goldman Sachs thinks they're going to be flat. You've got different economists saying different things. Really, everybody has taken the 50 bip raise off the table that they were talking about last week before SVB. Given all of that, we're going to see the Fed is going to have to rethink how fast they're raising the Fed rate and to what point do they start slowing it back down again. This bank collapse does change everything. We'll have more to follow. Definitely we'll be talking about it at DMAR's Warning Graphic Images class tomorrow. We'll be talking about it again on Thursday with Megan Aller. And of course, I'll be highlighting the week's events on our Saturday blog. If you're not currently signed up, make sure to DM me or post a comment down below. You guys have a great rest of your day, and I'll talk to you soon.